Welcome to the Bank of England special session on UK financial institutions, behaviour under stress, a granular investigation of credit, liquidity and markets, fire sale risks. I'm Marina Barnett. I'm a senior technical advisor and head of the FS Strategy and Projects Division at the Bank of England. The papers in this session cover three sort of sources of risks, or three dimensions: credit, liquidity, and market risks, and exploit a bunch of granular supervisory loan level data and security exposure data sets to study how risks propagate within the UK financial system, with a focus on UK banks. Now, we have 4 papers today, and we'll spend about 20 minutes on each paper, split between 15 minutes of presentation led by the author and a 5 minutes discussion led by a discussant. We'll conclude with a 10 minutes Q&A at the end of the 4 presentations. However, if you have questions and you are raring to go and you really like to pose them, please use the Q&A button and submit them through there. I'll monitor them and I'll bring them in right at the end. But also please do use a hand up, the hand up function if you want towards the end, and I will pick those up. The session is recorded, so please keep that in mind. I will also keep to time, so apologies if I will interrupt some of the speakers as I go along if I don't get a sense that you are coming to an end. We'll start with Giovanni presenting the UK banking system, a systems global network of granular exposures, and we'll follow up with Marco, who is going to discuss it. Giovanni is a research economist in the stress testing and strategy division at the Bank of England, and Marco is a senior economist in the research hub division at the Bank of England. Giovanni, over to you.
Thanks a lot, Alina. So my slides are shared. So today I'm going to present my paper on a UK banking system global network of granular exposure. This is a joint work with James Rook and Charu Raja, both from the Bank of England, and the usual disclaimer apply. So the paper contributes to 3 main topics. So the first part, we try to construct the UK banking system global network dataset that is actually capturing 90% of the banking mapping long distribution stochastic system methodology for assessing and monitoring on a quarterly basis credit risk for the UK banking system in order to model scenario uncertainty and also capture concentration risk and interconnectedness in order to derive the loss distribution for the UK banking system, and so actually develop a quarterly updatable desktop stress test. The last contribution of the paper is derived 2 measures of solvency risk, specifically capital at risk measure, that is a measure of one year ahead potential expected losses, and a measure of conditional capital at risk that actually capture potential tail losses and their probabilities. The main findings of the paper actually focus on empirically estimating the loss distribution during the COVID pandemics, and what we measure is actually that expected losses average pre-pandemics around 27 billion in the UK banking sector, and due to the pandemic increased to 37 billion at the peak in Q2 2020. And actually in the last data point that we have in the sample in Q4 2021, they are still above the pre-pandemic level to 31 billion, even though they decrease. Second findings that we have is that actually tail losses during the pandemics at the peak amounted to 147 billion, almost 61% higher compared to pre-pandemic levels that were averaging around 92 billions. And the probability of the UK banking sector experiencing an extreme tail event of roughly 92 billions increased from 1% pre-pandemic to 4% at the peak, for then slightly decreasing to 1.7% in Q4 2021. One of the key policy implications of this paper is that actually we show that average risk increased less than tail risk during the period of the pandemic, meaning that actually expected losses are not a good proxy for measuring the severity and probability of banking crisis. One of the key features of this project is actually to develop and construct the network of granular exposure as shown in figure 1, and actually try to capture those two features that matter for assessing and measuring the distribution of shock, and then quantify the level of systemic risk in the system. These two features are the level of interconnectedness and concentration risk. What you can see from the picture is actually that all the counterparty entities of the UK banks that are captured by the black circles do enter in multiple UK banks portfolio. So those entities actually overlap in multiple portfolio of UK banks, and those type of exposure are also can be defined as large exposure, reflecting a high level of concentration risk, meaning that a shock to one of those counterparties may definitely affect simultaneously multiple UK banks. And a stress test methodology should try to capture those network features in order to properly model tail risk. And this is what we are going to do. So just to have a quick description of the methodology, what here we develop is a stochastic balance sheet-based microstructural methodology. And we do that in order to derive the loss distribution for the UK banking system as a function of the network of exposure, which EXP IJ refer to, and multiplied by a loss given default parameter that is exposure specific, and then we derive also a scenario matrix with roughly 20,000 simulations for each probabilistic scenario in order to derive stochastically which counterparty entity of each UK banks is going to default in each of those scenarios. Once we have derived the loss distribution, we derive our two measures of risk, one that is capital at risk, that is actually reflecting the mean of the loss distribution, expected losses, and one that is conditional capital at risk, that is taking the percentile of the loss distribution, specifically the 1990 percentile, in order to capture extreme tail events. So thanks to that, we achieve a rich set of results. The first results is actually that we are going to display in figure 2 is the development of expected losses, capital at risk. As you can see, capital at risk averaged around 27 billion during the pandemic. And actually, at the start of the pandemic, capital at risk increased, and it reached a peak in Q2 2020 of 37 billions, up by 36% from pre-pandemic levels. And this is mostly due to an increase in banks' counterparty risk as the results of the COVID-19 pandemics. In the end, in the last snapshot of our dataset, what we can see is that in Q4 2021, the estimates are still above by 70% the pre-pandemic levels, roughly around 31 billion. To what may concern instead not the mean of the distribution, but the severity of tail events, here we provide a picture 3 for capturing conditional capital at risk evolution. And what we can see that the severity of tail events remained quite stable before the pandemic period, averaging around for extreme events of 91 billion. And at the peak of the pandemics in Q2 2020, the severity of extreme tail events reached a level of 147 billion of potential tail losses. And this level decreased to roughly 110 billions at the end of Q4 2021. One of the key things that we try to do in this paper is to ask ourselves, what is the probability of experiencing at the peak of the crisis the same type of extreme stress event as classified during the pre-crisis period? And this is what we try to assess in probabilistic terms. So the answer is that extreme stress event of losses up to crisis. Sorry, I put them with a PowerPoint. And at the end of the period, what you can see that this probability actually is still above the pre-crisis level, and it averaged around 1.7%. So meaning roughly during the peak of the crisis, one extreme scenario every 24 years compared to pre-crisis level, there was one extreme scenario of 91 billion every 100 years. So what we can do, we can also decompose the risk factors of the tail loss distribution And what we can see that actually counterparty defaults risk, approximated the probability of defaults, are the major driver in the increase in tail risk. And instead, the network structure had initially a positive contribution to tail risk, while actually, thanks to banks' rebalancing strategy, so asset reallocation, the network structure became a negative contribution, meaning that actually there was an effective reallocation of exposure throughout the network during the pandemic. And the other things that we can notice that the contribution of each risk factor to change in tail losses varies remarkably across time. So to conclude, what we have seen in this paper is that actually tail risk strongly declined relative to the level reached at the peak of the COVID-19 pandemics, Q2 2020, but still remain higher than pre-pandemic levels. The second findings that I want to highlight to conclude is that capital at risk, the measure of expected losses, is not a measure of conditional capital at risk. And as we have seen, capital at risk increased by 36% more, and while conditional capital at risk increased by 62%, meaning that average risk cannot be a good proxy for measuring tail risk. An important findings is also that banks' portfolio rebalancing strategy actually helped to reduce tail risk during the COVID-19 pandemic, thanks to an effective reallocation of exposure away from tail risk. And in the end, what we want to emphasize that thanks to the UK Banks Global Network, and thanks to the methodology of conditional capital at risk and capital at risk, we could quantify and monitor the severity and probability of tail events and also their developments, try to decompose and track the sources of tail risk, and potentially also answer what-if policy question by performing counterfactual policy exercise. Thank you.
Thank you very much, Giovanni. Marco, over to you.
Yes, let me share my screen. Is everyone able to see my slides?
Very well. Okay. Thank you.
Fantastic, thanks. So very happy to be discussing Giovanni, James, and Charu's paper. Usual disclaimer applies for me as well. So I don't have a lot of time, so I'll give a very quick summary. And I guess one of the main outputs of this paper, apart from the analysis, is really building this granular data set of exposures of UK banking sector. And I'm very much supportive of this. And I understand how much work went into it, cleaning definitely emerging. So this covers about 90% of the asset side of UK banks, and about half of it is granular. So it gives us a reasonably complete picture of half of the underlying network. It's quarterly, and we have 36 UK reporting banks and thousands of counterparties. So then what the paper does, on top of building the data, it does some sort of summary statistics, we could call it. So it looks at the a few concentration metrics, and then computes risk measures. And I guess here some of the main caveats are that those are computed based on quantities that are self-reported by institutions, probabilities of default and loss given default. And a very quick comment also here I'll come back to is that obviously with such good underlying data, one would be tempted to build a contagion model on it, but this is not happening in this paper. So maybe for a follow-up. So that said, let me talk about some of my comments, my observations, and some of it are things that are not entirely clear in the paper. So for example, there are a couple of quantities that are computed, such as power law index for networks. And it's not clear how this has been computed and what kind of statistical significance those numbers have. Same for the core prefix structure. So in the paper, it said that those networks have a core prefix structure, which is a finding that's common to a lot of financial networks. But nevertheless, there are some statistical tests that one could perform to check that. And I'd like to see that in the paper. On concentration metrics, for example, one of the metrics, cons, doesn't really seem to be, at least in the version for counterparties, to be a metric of concentration, but more a measure of imbalance of inflows and outflows. And again, some of the metrics of overlapping portfolios, again, seem to be more measures of second order connectedness. So it's not clear whether there are problems with the notation there or more let's say fundamental conceptual problems. So I encourage the authors to clarify that point. And again, it's not clear how the different concentration measures are aggregated, and then institutions are somehow divided into different tiers. A suggestion could be to for example, track the Erfindal-Hirschman index, which is something that it's just a number for the old network rather than a vector of numbers as currently is, and the authors could easily track that number through time and make points of whether the concentration is increasing or decreasing over time. On the risk metrics, I found quite confusing that the names of the two risk metrics, capital risk and conditional capital risk, are very, very similar to what people, to the names that people would use in the literature on risk measures to refer to value at risk and expected shortfall. But then by reading the paper, it's clear that they aren't. And this makes reading the paper quite counterintuitive. And actually, only one of them is as a stochastic component. So maybe the authors could find a better choice of names and explain this a little bit better. Again, it's not super clear why capital at risk does not account for the network of exposures, while conditional capital at risk does. There's an element in the correlations there, but I think the authors should make an additional effort to explain this point better. There are some additional small technical points that I think I don't have enough time to go into here in the computation of those metrics, but I'll pass them on to the authors. On visualization, which I think is an extremely important area for a paper like this, I think again the authors could make some additional effort. Some tables could definitely be turned into charts. I find it quite struggling to, for example, follow the evolution of some quantities over time. For example, concentration metrics, again, is one of them. They could compute the Hedge index, and then this could easily be shown. One thing that it's typically criticized in network papers is when authors draw conclusion from what it's actually called in the literature airballs. So those graph of networks in which you can barely distinguish nodes and edges, and sometimes this is done in the paper. So again, I think the authors should present the evidence rather than just referring to a picture that's very hard to interpret. A small comment on cumulative densities, which again I found quite counterintuitive to read. So it's not clear to me why the authors haven't just plotted actual cumulative distributions. They might have been easier to read. Maybe they could explore this. General comments, again, coming back to model incantation, because obviously seeing such a rich data set, somehow, what's your appetite? So it's probably not for this paper, but I guess the author should at least hint to the possibilities, or that are on the table with such data. Maybe a slightly less ambitious step, they could compute standard centrality measures, which is something that's often done in the network literature, and track them over time to show whether nodes become more or less central, and which nodes. I found slightly misleading the name global network as, and I understand the meaning here is that the counterparties are global, but this is very much UK network. So I'm not entirely sure. And another small comment, I often found a pre-crisis in the paper, and it wasn't entirely clear which crisis. I think it might have been the COVID crisis, but but it was a little bit ambiguous. There's a couple of missing papers from the literature review that I'm also reporting here. I guess that's all for me. I hope I'm within time.
Just about. Thank you very much, Marco.
You're welcome.
We are now moving on to the second paper of the session, Hedge Fund Behavior in Gilts and Gilt Repo Market during COVID-19, with Anne-Caroline presenting. Anne-Caroline is a senior research economist in the same division, the Stress Testing Strategy Division at the Bank of England, and it followed by Karamfil Todorov, who's an economist at the Monetary and at the BIS in the Monetary and Economic Department. Anne-Caroline, over to you.
Thanks very much, Alina, and thanks as well to Giovanni for putting this nice session together. I can hope you hear me all well and see my slides. So I will present today a quite new project on hedge fund behavior in gilt markets that I'm working on jointly with a colleague from the Bank of England, Laura Silvestri, and with Professor Ludger Verad from the LSE. And as for most of our presentations, the usual disclaimer applies as well here. So the motivation for this project is that we all know that hedge funds act as arbitrageurs in financial markets, and they're often defined as leveraged investors, but they do use a variety of investment strategies that we often don't really know many details about, that are quite opaque to us. So in this project, we try to address two questions on hedge funds and shed a bit more light on their behavior. So one of them is, how do hedge funds behave in stress? And the other one is to try to understand a bit better what their different trading strategies are, and if we can actually see that they have different behaviors in normal times and stress according to their different trading strategies. So how we go about this? So we have a very granular data set on transactions of hedge funds, both in the gilt repo market and in the gilt cash market. And then we use a network approach to study the behavior of hedge funds before, during, and after the COVID-19 stress by splitting them into different trading strategies. What we find overall as a quick preview is that hedge funds didn't deleverage during the COVID-19 stress, but we find that global macro and relative value hedge funds started building up leverage after the COVID-19 stress. Just as a quick background, so what do we already know before we started the project on how the COVID-19 stress played out in the UK gilt market? There were a few previous research projects at the bank. So the first one was looking more into the gilt repo market. And there we found that in normal times, hedge funds are marginally net borrowers in the overnight gilt repo market, and that they did significantly increase their borrowing in the overnight gilt repo market during the COVID-19 stress. For the gilt cash market, so the market in UK government bonds, we found that overall there were net buyers during the dash for cash. So in both cases, increased net borrowing and increased net buying. But here we're going to try to break this down further and have a look at how they behaved by different trading strategies. So I will first very quickly talk you through the data set that we built, then give a few select descriptive statistics on the gilt repo market, then on the gilt cash market, and then finally try to shed some more light on how hedge funds behaved in these markets during the stress. So first of all, we built quite a granular data set based on transaction level data on the gilt cash market, which is MiFID II data, and on the gilt repo market, which is the Bank of England sterling money market data. And then we have a third data set, which actually gives us the trading strategy of the different hedge funds. So we don't have to impute it from running data analysis. This is something we can use as a given in the data and then do further analysis on actually how do these different groups of hedge funds behave. We then add some additional characteristics on UK government bonds from the DMO website, so that is public data. And then at the end, we have quite a substantial granular data set on transactions between dealers and hedge funds, split into relative value, global macro, and a kind of residual other trading strategy. And we can also split the gilts and the collateral according to different maturities. So we have quite a few dimensions according to which we can work with the data here. So let me briefly give you some insights into hedge fund activity in gilt repo. And here you see a time series chart where you have 6 months before the COVID-19 stress, 6 months after. And the daily transaction volumes are split by the trading strategy of the hedge fund. So you see that in purple is the relative value trading strategy in terms of daily repo transactions, so daily repo borrowing. You see that relative value is quite steadily the biggest one in terms of volumes transacted, but that global macro, especially after the COVID-19 stress, so which is kind of in the middle of the time series, you see that there's definitely a strong pickup in daily transaction volumes performed by global macro hedge funds. And overall, you also see that there's clearly an increase in volumes transacted in the gilt repo market after the COVID-19 stress. If we now look at net borrowing in the gilt repo market by strategy, you also see that there's some interesting patterns and changes we observe over time. So while all the different hedge funds were net lenders before the COVID-19 stress, there's clearly a flip in spring of 2020, where most of them become net borrowers in the gilt repo market, which is consistent with the liquidity stress, one might think. But it's interesting that this actually persists and actually even increases after the COVID-19 stress, such that now actually all three trading strategies and all three groups of hedge funds are now in the net borrowing territory in the gilt repo market. Moving on to the gilt cash market, which is the UK government bond market, we can see that it's a lot more spiky and volatile in terms of daily purchases of gilts. And we see that other and relative value hedge funds have the largest share of daily gilt purchases. And we have a similar chart than we had for the repo market here for the gilt market in terms of now net purchases of gilts. And then we also see that there are some changes in positions in this market. So while most of them were net sellers prior to the COVID-19 stress, there's been a bit of a flip for others and relative value hedge funds. And we can see that now relative value is clearly a massive net buyer of gilts. And global macro is kind of moving also into that territory now. So there are clearly some shifts we can document just by exploiting the data and just visualizing it quite simply. Beyond this kind of exploring the data and just learning from it some stylized facts, we also built a network on which we ran some statistical analysis. And here we built a dealer hedge fund network where the nodes correspond to the hedge funds using different trading strategies. And here we focus on global macro and relative value, because the other is basically a mix of strategies which are quite hard to interpret on aggregate. So, and global macro and relative value are the biggest ones in any case. So we focus on those here to simplify a bit the analysis. And then we split the dealers into nodes depending on what the collateral used in the transaction represents. So what the maturity of that is, the remaining one. So the links can correspond to either, if we look at the gilt repo market, at repo transactions then collateralized by a gilt of a specific remaining maturity, or if we look at the gilt market, they will represent cash used to purchase a gilt of a specific remaining maturity from a dealer. And we run a very simple statistical analysis, which here looks not very simple, but it's basically just a linear regression model with which we try to assess how statistically significant the changes are in volumes from pre-crisis times, so normal times, to stress times. That is the main aim of this simple linear regression model we apply to the network. And given we only have 50 minutes, I will show you one snapshot of the results, which is for the Dash for Cash episode, which basically, if you think of how the COVID-19 stress evolved, initially there was a flight to safety where there was a massive kind of rush to save assets such as government bonds, but then in the Dash for Cash, there was a rush to even higher liquidity, namely actually cash. And so this is kind of considered to be kind of the really hot phase of the liquidity stress. And so what these little heat map pictures show you, so on the left-hand side, we see the repo network, and within that, the upper left rectangle, which is blue. Given the time, I'm not going to go into too many details, but this is evidence of, is that hedge funds, no matter which strategy, lent a lot less cash in the repo market during the Dash for Cash, which is consistent with a liquidity stress, so less lending of cash. But in the lower right rectangle, which represents the cash borrowing, we also see that they did indeed, in both strategies, really borrow a lot of cash, again, consistent with the liquidity stress. It has been kind of often as a behavior, also if we look at the US Treasury market and hedge fund behavior there, that they have been massively deleveraging US Treasuries. And so if we look at here on the gilt network now, whether we can see similar behavior in the gilt market, we actually see much more mixed evidence in the UK of that behavior. So in terms of deleveraging, we would look at the gilt network at the upper left rectangle, which shows you the sales, and whatever is blue means a decrease in sales, and whatever is red would show an increase in sales. So there's clearly both red and blue, and there's mixed evidence. So for some maturities there have been sales, and for some maturities there have been less sales. So there's clearly mixed evidence on the leveraging on that side. And there are even some purchases. So if we look at the lower right rectangle, again, there's blue and red. So there's been more purchases in some cases, and in some cases less. But for relative value hedge funds, for example, we see that there have been quite a few more purchases, especially of the short and the medium maturities. And these are kind of just, I mean, this is a statistical analysis, but this is still kind of trying to make sense of the data. This doesn't imply causality just yet. And we have started to move into, and this is my last slide before the conclusion, into a kind of more causal analysis of how these hedge funds behave across those two markets. So we were interested in trying to find out whether they would buy gilts first to then borrow against them in the repo market, or vice versa. So what we find as initial results, so after the COVID-19 crisis, so post-stress, one result we find is that buying causes borrowing. So they buy the gilts first, and then against those gilts would borrow cash in the repo market. And this is both for relative value and global macro hedge funds. This is kind of the causality we identified. And I'm going to conclude by saying that, again, the main findings were during COVID-19, hedge funds didn't deleverage. We find that after the stress, clearly there's a big pickup in leverage of hedge funds. And what we want to do next is look more into also gilt prices and gilt rates and gilt repo rates to see how the prices also come into this. I'm going to stop here. Thanks, Karen, in advance for the discussion.
Thank you very much, Anne-Caroline. And Karanfil, over to you.
Do you see my slides?
Yes, they look good.
All right. So first of all, thanks a lot for inviting me to discuss this interesting paper by Anne-Caroline. So the usual disclaimer applies, first of all, and then my discussion is going to be first basically summarizing the paper, and then I'll talk about my comments and the questions that I had while reading the paper. So what this study does is they have pretty nice data set on hedge funds transactions in the UK gilt, cash, and repo markets. And they focus on two types of hedge fund strategies, relative value and global micro. And what they find is that hedge funds did not engage in any deleveraging during the COVID-19 stress, but afterwards they increased leverage. And that's a quick summary of all the findings in the paper. So I have three sets of comments, and the first one is about trying to offer more explanations on the facts reported in the paper and try to combine them in some kind of a story. So, for example, there are several patterns that the authors report in the data. For example, they show that hedge funds, global macro hedge funds, switched from net sellers to being net buyers after COVID, and general hedge funds switched from being net lenders to being net borrowers after COVID. And at the same time, we see a change in maturities that they use for borrowing and for lending. For example, for borrowing, they use short and medium term bonds, whereas for lending, they used also long-term bonds. And I was wondering whether these findings could be explained by some shifts in monetary policy around the COVID, for example, by changes in the Bank of England rates, or by changes in the shape or the slope of the yield curve, or even by some P&L dynamics by global macro and relative value hedge funds around COVID. So, for example, if some of these hedge funds became bankrupt after COVID, they would basically exit the sample, and then that could influence some of the dynamics that you see in borrowing and lending, and then also in the gilt cash market. So in general, it would be good if you can think about a story that would combine all these facts and then test this story in the data. I think that would be more interesting than simply reporting some of these patterns, and would make the whole paper more interesting. So then the second comment is about the leverage and the split on different types of hedge funds. So first of all, one of the findings of the paper is that hedge funds increased their leverage after COVID, but the evidence of that is that the evidence of this finding is that hedge funds decreased their lending after COVID, which suggests that they're taking up leverage. So one comment that I have here is, do you have evidence on absolute levels of lending or on relative values of lending in terms of share of borrowing relative to the assets under management of these hedge funds? Because if they grow after COVID, then of course the absolute values of lending could decline and absolute values of borrowing could increase. So I wonder if you can normalize this by the AUM of hedge funds to see whether their relative borrowing increases after COVID. Then the second bullet point is about the split. So it's an interesting split between relative value and global macro because there are two different types of hedge funds and they have different types of strategies. But throughout the paper, I was not sure why you actually do the split. So I would spend more time on motivating the split and then looking at the facts through the prism of the split and highlighting the differences between the two categories of hedge funds and trying to square these differences with the difference in trading strategies that they employ. And then in general, I was wondering whether this data on strategies is actually time invariant and how reliable it is. So can, for example, some hedge funds switch their strategy before and after COVID, and could that explain some of the time series dynamics that you see in the data? And then the last set of comments is about how to restructure some of the parts of the paper and some of the figures and tables. So for example, I think definition 2.1, where we talk about 6 different time periods, I think that would look better in a table where we just have the 6 periods and then the start and then dates. It's just easier to read. And then in general, I was not sure why you need 6 periods in the whole paper. First, because the cutoff dates were a bit blurry to me, so I didn't understand why, for example, safety or dash or policy are determined by those dates. So maybe you can elaborate more. And then these periods have different lengths. So comparing the absolute volumes during these 6 periods and the number of hedge funds active, it was a bit unclear to me why you do that type of comparison for heterogeneous periods. So I would normalize them by the number of days and just compare the averages, for example. And then in general, I was thinking, even in the presentation, you basically talked about pre, post, and during COVID dynamics. So I was wondering why you need 6 periods, and can you just do it with 3 periods, the whole analysis? Then I have some small suggestions about what to put in the figures. So for example, I think it's easier to put, it's more intuitive to put volumes of trading by hedge fund instead of number of hedge funds active, because as you report in the paper, the top 3 hedge funds are the largest ones. And what we care about is volumes rather than the number of hedge funds active. And then, so the last set of comments is about, again, some of the figures. So for example, I was wondering, what are the spikes in figure 11 that you actually showed in the presentations? Is it related to weekends? Because there were like 12 spikes during a quarter. And I wonder if there are some interesting dynamics of hedge funds borrowing and lending around weekends. The heat map that you showed, so I was wondering if there is an easy way to convey the same message, because they were kind of hard to read. And then the last thing is about the volume notation. So I think you used V for volume.
I think we're really running out of time. If you could just take the last second to finish up. Thanks.
So just to conclude, let me just say that it's a pretty nice data set, many interesting findings. And the only thing that I would suggest is just combining these findings and restructuring them and putting into some big picture story, which would make this paper even greater. Thanks a lot for your attention. Let me stop here.
Thank you very much for the comments. Can I remind everyone that if you have questions, put them in the Q&A box and we'll collect them towards the end. Moving on to the next paper, can banks use their liquid asset buffers? Guillaume is going to talk us through that paper. Guillaume is a senior research economist in the stress test strategy division at the Bank of England, and followed by Arthur, who's is a research economist at the Prudential Framework division at the Bank of England, the BIS, excuse me. And he's going to be the discussant after Guillaume. Over to you, Guillaume.
Hello. Hi, everyone. Thanks, Elena. Hopefully you can see my slides. Everything is fine. Other one, just let me know.
It looks good.
Cool. Thank you. So good afternoon, everyone. So many thanks for having me today. So I will present the paper, Are Banks Willing to Use Their Liquid Assets, which, as the title hints at, will discuss the usability of liquid asset buffers. So this is a joint work with Paula Gallego-Marquez, a Bank of England colleague, and Antoine Lalour, a former Bank of England colleague. So, and obviously usual disclaimers apply here. So first of all, why do we ask these questions? Why do we think it's important? Why do we want to write a paper on that? Well, the Bank of England recently published a whole discussion paper actually on the topic, analyzing the issue and the option to try to progress on this question. So I encourage you to, if you're interested in the question, to check it out, but I'm just going to summarize it really quickly here. Basically, Basel III introduced 2 liquidity ratios, the LCR and the NSFR. So the LCR, which has been in place since 2018, requires banks to hold liquid assets in normal time so that they can use it and withstand a short-term stress or a 30-day liquidity stress. And the way it was designed with the idea that these liquid assets are supposed to be usable. They're like a stash that is built up during normal time to be used in stress time. But the stock of liquid assets has limited benefits if banks do not use it in stress, actually. So if banks prefer to take actions to generate liquidity in stress, so instead of using the stock, the buffer they've built in normal time, if they prefer to take actions that will generate liquidity during the stress, this may have adverse consequences on the rest of the financial system and on the rest of the real economy. So for example, if banks do not refinance reverse repo, I mean, a bit like what we've seen with the previous presentation of Caroline with hedge funds. But if banks do the same also and they retract from the reverse repo, or if they reduce lending to the real economy, all of that will have is going to amplify the initial stress in the financial markets. So understanding better how and to which extent banks are willing to use this liquid asset buffer helps understand liquidity stress dynamics and also contributes to the work of the evaluation of the Basel III reforms, which is very much ongoing. So essentially, we ask the question, do banks manage their LCR when facing liquidity pressure? All right, so, so to answer this question, we use a panel of 31 large banks, which comprise different kind of banks, so major UK banks, smaller ones, but also investment banks, so essentially by opposition to retail banks, and also ring fence banks. So we focus only on a year period, so between September 2019 and September 2020, essentially because this is September 2019 where our data starts. Then it covers the COVID financial stress, some of the period before, some of the period after, but we plan to expand it later on. Then we use essentially regulatory data. So firstly, what we call the core returns to build the liquidity buffer, so the level of the LCR. And you can see the average LCR on the plot on the right of the slide. And there's two interesting features I just want to point out in this chart. Firstly, the drop in the start of the stress. So between January until April, you see there's a relatively sharp and pronounced drop at the moment of the liquidity stress. But really quickly, you have right after a large and quick rebound. So banks did take a lot of action to buffer up their liquid asset buffers. Then we also actually collect public data to look at what banks disclose about their liquidity position and especially about their LCR. So this is because we think this has an impact on buffer usability. The idea behind is essentially that the more information banks disclose to the market, essentially here we mean spot, which is the actual LCR at the moment of the disclosure versus averaged or no information about the LCR. So the more they give information to the market, the more potentially the market will react, because there's always especially if the change in the LCR is unexpected, because there's always a risk this is going to be a signal that something wrong, something bad is going on at the bank, even if it could be genuine changes in the LCR. But during stress, there's always a risk, and the market may react very strongly to any change. So basically, we think the more information banks disclose, the more they will try to manage their LCR. So we also use another regulatory data, which is a weekly return on liquidity position of banks. So amazing data set, obviously. And we use it to build two metrics. So the first one is a metric that captures net exogenous liquidity pressure. So that's going to be the first row of the table below. So it captures essentially flows, liquidity flows that banks have no control of or very little control of, but it's not always negative liquidity flows. So some of them can sometimes be positive, some of them they can be negative. So typically margin flows can sometimes be positive and sometimes be negative. But the whole idea is that it's going to be pressures that we're going to call net pressures that banks have no or very little control of, and they're going to face it without really being able to control them. And then we built another metric, which is going to be what we call liquidity actions. And this is essentially something that captures endogenous liquidity decisions, liquidity raising actions that banks are going to take. So it's essentially comprised of debt issuance and the use of central bank facilities. And this is really action that banks have really mostly control of. And so that means they really took the decision to shore up liquidity if they took those actions. All right, so finally we used those two metrics to build our two matrix of interest that we're going to use to run our regressions. So we build a metric that is called buffer after pressure, which is essentially the difference between the liquidity buffer minus the pressures. And we do that both for the minimum LCR and what is the Pillar 2 guidance, which is like bank-specific, undisclosed additional liquidity requirements. So essentially, this liquidity buffer after liquidity, so this liquidity buffer after pressure, is essentially a way to tell us how close to regulatory minimum so banks would have fallen after pressures if they hadn't taken any action or had no other inflows. So just a metric to see how low potentially they would have fallen facing pressures. And then we compare this buffer after pressure with the amount of action banks are going to take on the same week. So that's essentially our approach. And then we just use very simple panel regressions to compare those two metrics. So with time and bank level fixed effects, we also control for heteroscedasticity. And we also introduce a few dummy variables just to explore some heterogeneity in the results. And I will explain a bit more later on why exactly we choose those dummy variables. All right, so what do we find? So our main result is that there's a negative and significant relation between actions and the level of buffer after pressures. So that suggests that banks take liquidity generating actions when the buffer is lowered by pressures. So that's what you can see that works both for the LCR as a base for the buffer, or Pillar 2 as a base for the buffer. The two coefficients are relatively similar. However, the coefficient for both is actually relatively small. So the way the coefficient can be read is that if there is a 1% buffer drop, so if the LCR goes from 121 to 120, for example, so if the buffer goes from 20 to 19, banks are going to take 2 to 3 basis points of actions. So again, relatively small. So the reason why it is relatively small, it's probably because we only have a very limited set of actions that we capture in our metric. This is something we are planning to expand, and early results suggest that this is part of the explanation, because if we expand the scope of the metrics, our results, the coefficient also tend to increase. But there's also another explanation, which is that we only look at the same week as the pressures. So it's very likely that banks tend to smooth actions. So they don't, it would be really costly if banks wanted to completely erase any liquidity pressure the same week of the pressure. So it is very likely that due to just quantity or price constraints, banks tend to smooth the actions they take after pressure. And this is also something we are looking at the moment. And then finally, another explanation could be just that this is an average coefficient, which just hides a lot of heterogeneity. And this is what I'm going to show you right now by the additional analysis we've conducted. So the first one that we've looked at, the kind of heterogeneity in the results we've looked at, is whether banks, what kind of information banks disclose. to the public, to the markets. So essentially, we compare banks that disclose spot LCR, which is the LCR, the precise LCR at the date of the disclosure. So if they disclose annual report on the 31st December, this is the LCR at the date of the moment the report, the balance sheet of the report was taken. So we compared this kind of spot LCR disclosure versus banks that disclose either averaged LCR or just no information about the LCR. And we find that the more banks disclose, so here spot, the more any change in the LCR will be visible to the market, but the more banks take actions so in response to that. So that suggests essentially that banks that disclose spot tend to manage the buffer more, essentially, most probably because they are worried about a potential market reaction. But you can see also that the coefficient here is much higher than the one from the baseline. So that shows that this is driving a bit the relationship. We also then look at the role of business model. So major UK banks versus smaller UK banks, ring-fenced and investment banks. So we look at the business model essentially because this has both an influence on how much liquidity pressures banks may face in a stress. So it's typically pure retail banks are probably less exposed to stress in the repo market, for example, because they don't really have large repo books. But also it has an impact on how much the scope of actions banks can take. So typically non-retail banks this time, they have a smaller scope of collateral they can pledge to the central bank. So that means they cannot rely as much as retail banks on central bank facilities. So what we find here is that only for major UK bank and small UK banks, there is a negative and significant relation. And it is also much larger than the baseline. And as I just said, this could be explained by the fact that the way we construct our action matrix, so the amount of actions to increase the liquidity banks can take, this is essentially limited to debt issuance or central bank facilities. So by construction, this is not really capturing what actions like investment banks could take, which is probably more going to happen on the repo markets. But again, that's something we are planning to look at. Finally, the last kind of result we explored is whether this relationship changed after the start of the COVID stress and after the activation of additional central bank facilities following the start of the COVID stress. So we defined the start of the COVID stress at early February, which is so the 7th of February, and central bank facility activation. So obviously, given that we use only UK banks, we only look at Bank of England central bank facilities activation, which is essentially on the 17th. And
yeah,
then
I'm sorry to interrupt.
Yeah,
probably worth thinking about wrapping up.
Yeah, that's my last slide.
Thank you.
Essentially, we find that central bank facilities, it does have negative and significant relation after the activation of central bank facilities, but not really before. And same for the COVID stress. So potentially, this is where most of the banks tend to take action to manage their buffers. So that's all for me. I'm going to then pass on to Arthur for the discussion. Thanks, everyone.
Thanks, Guillaume, and thanks everyone for inviting me to discuss this very interesting paper. So let me just mention that the usual disclaimer applies also to me. So let me start with a context. So following the 2008 financial crisis, we saw an increased global effort to strengthen financial stability through various regulatory reforms, which not only aim to improve the capital adequacy of financial institutions, but also introduced various measures to address the liquidity risk. And in particular, the introduction of the LCR, the key measure described in this paper, aims to promote the short-term liquidity profile of banks so that they can draw on liquidity in more reliable and timely manner during times of stress. And indeed, it is important that the banks draw on this liquidity buffer when appropriate, since if a regulatory buffer is not practically usable and instead treated as minimum requirement, then it has little value in helping firms to absorb shocks in a way that keep lending going. So as such, the question of effective buffer usability is important from the perspective of financial stability, and in general relates to both liquidity and capital buffers. However, the empirical literature on this topic tends to typically focus only on the capital side of the issue. And as such, this paper provides a valuable contribution to the field by offering an empirical view of UK banks and their degree of active LCR management following a liquidity stress caused by pandemic. So in particular, this analysis considers important factors that may impact the degree of active LCR management of banks, including the level of LCR disclosures, the business model, and the impact of central bank facilities. The granularity on the view of LCR management offered through the lens of these factors is a new and welcome contribution. In particular, the paper shows that UK banks have actively managed their LCR ratios during stress, with more actions taken at lower LCR levels. The analysis suggests that prior to the pandemic, banks managed LCR in a business as usual way, where changes in LCR buffer didn't seem to have significant impact on the actions taken. However, following the COVID shock, a significant relationship can be observed between actions and LCR buffer levels, where banks seem to partially replenish LCR buffers over time. Consequently, the paper argues that this is a sign of reluctance in the LCR buffer usage, which is in line with the results of the, for example, 2019 Bank of England liquidity stress testing exercise, where banks seem to be generally unwilling to allow their LCR to fall below 100%, even under a very severe stress. That said, I believe the paper could benefit from further discussion on this point. So in particular, the authors could further explore the intricate question of whether the bank's observed behavior relates to the reluctance of buffer usage. And for example, this could be due to market stigma or other factors. Or is it a prudent action given the prevailing market conditions and a result of, say, central liquidity provisions? So in general, this question is little explored overall in the literature and could shed light on the underlying factors driving the observed behavior of banks and their impact on financial stability, especially from the liquidity angle. Moreover, quantifying the cost of these actions could be an interesting consideration in the analysis, allowing us to see whether banks are willing to pay an excessive cost to maintain their liquidity buffers during stress, or is it simply that, for example, they have the means to do so at a low cost as a result of the intervention from authorities. Another thing to keep in mind when interpreting the model results is the nuanced nature of the LCR measure itself. So although typically an adverse shock produces a drop in LCR, it can also result in an increase in particular cases. So this is a quite subtle point that could be further discussed in the paper. And to that effect, it would be also helpful to understand whether the evolution of LCR and banks' behavior by providing a more detailed analysis of time series of LCR and its components. On the modeling approach itself, it would be interesting for the authors to discuss the suitability of the current linear model choice. To me, it is not clear that the relationship between LCR actions and buffer level after shock should be linear in real life. So presenting the results from the model's residual analysis could be helpful to address this point. And similarly, when considering actions taken by banks to rebuild the LCR buffer, the authors could describe the dynamics of this more precisely. For example, whether banks rebuild their LCR in a linear manner or not. Moreover, the current linear model in this paper can be enhanced by considering interaction effects, for example, between business model and key dates. And this may shed light on results that are currently not explained. For example, why a significant relationship is observed between actions and buffers after pressure, only for certain business models. So finally, I would also suggest that you report confidence intervals for coefficient estimates instead of just point estimates to ease model interpretation. So let me just conclude by saying that this paper is a very welcome contribution to the literature on buffer usability from the liquidity perspective. And in particular, the presented empirical evidence from the pandemic sheds light on effectiveness of current regulatory buffers during period of stress, which has important implications on financial stability. Okay, so let me stop here and say thank you.
Thank you very much. Moving on to the next paper and last paper of the session, the fire sale risk in fixed income markets. Riz Bidder is going to present the paper. Riz is the Deputy Director of the Qatar Center for Global Banking and Finance, followed by a 5-minute discussion by Salim, Associate Professor of Finance and Economics at UCL, also very much a colleague at the Bank of England in the Research Hub division. Riz, over to you. You have 15 minutes for your presentation.
Thank you very much. First point to note, the title has changed somewhat, something a little bit easier to sell, but it is still essentially the effect of stress selling in fixed income markets. My co-authors, very excellent co-authors, various of them require this disclaimer. It's a standard disclaimer, but a bit longer than most others. So this is really about fire sales, stuff that people are frightened of, stuff that is of interest to theorists and to policymakers. Okay, and what I mean by fire sales, or briefly, essentially forced sales of assets by, in some sense, distressed investors, such that the price is driven below what it might otherwise be on the basis purely of the fundamentals of the asset. Okay, and as has been alluded to really much of this session, it's a key mechanism by which shocks could be amplified and spread across different investors and institutions, which is one of the reasons why it's so carefully monitored. Okay, now there was a fairly settled consensus until recently regarding fire sales in terms of their existence and the fact that they can be substantial. Okay, and an important literature we relate to is literature that sort of was given significant momentum by Covell Stafford's work, who pointed out that because of the very narrow funding structure of mutual funds, open-ended mutual funds, they provided a good laboratory to see what happens if they suddenly have redemptions and have to sell assets. That in some sense is sales that are unrelated to fundamentals, so could be used as a form of exogenous variation to see if those sales could be absorbed in the market or started instead a drop in prices. Okay, various papers built on this, and indeed not just papers but whole literatures and not necessarily only papers that are concerned with the effects on prices per se, but once you have an exogenous variant in price, you can then see things like how firms' real investment actions might be affected by the cost of their debt and equity. Okay, but recently that literature's come under attack on methodological basis, whether or not there was sort of legitimate internal validity, and those papers that recently have addressed it a little more carefully maybe questioned whether or not there is such strong evidence that fire sales exist, or certainly in the context of selling by mutual funds, which is where a lot of the research has been done. Okay, so what we do today, we're going to suggest, firstly a methodological contribution. We're going to suggest a measure of selling pressure, which essentially all fire sales pressures papers need, that plausibly captures exogenous selling pressure. We're going to use some data that's already been mentioned, the MiFID II sort of bond transaction data. What's key by this data is it's very detailed, much more detailed than, say, Trace, as people might have used for US data. It shows us in particular who, apart from dealers, the various investors, people selling and transacting in these assets are, not just mutual funds, in fact. So we'll be able to distinguish, well, to some degree, with some degree of observation error, mutual funds and other participants. Okay, and the idea of our measure, in some sense, or I'll expand on this, is that it's going to be, well, we think convincingly unrelated to asset fundamentals. Okay, this word unrelated is doing a bit of heavy lifting in this sentence, and I'll elaborate on that because it's a little bit more subtle. Okay, so then we're going to instrument sales by non-dealers of various bonds with this measure. We focus on bonds. It's a particularly relevant set of type of security relative to the sort of very deep liquid, standardized and heavily followed stock that other fire sales papers could examine. And partly because we have such granular data, we're able to look into not just the average effect, but also whether this effect of this instrument selling depends on type of asset, person selling it. And in particular, given what's been discussed already today, we're going to look at how it varies over the sort of dash cash period. Okay, and I think there's some interesting complementarities with previous papers. We'll just check I'm doing on time. Okay, and ultimately we're going to find results that are sort of fairly reassuring if you're a fire salesperson. You know, in recent years, people have argued, well, fire sales maybe don't exist once you do things methodologically properly. Well, we think we're doing things methodologically properly, and we find economically and statistically significant impacts of non-fundamental sales on bond prices. Okay, and they're greater in times of stress and in corporate bonds, which aligns with various sort of complexity driven theories of what assets might be particularly prone to fire sales. Okay, and we do actually, in some sense, or this is preliminary results, begin to, I think, tease out why there might be a bit of tension between older and newer literatures. The newer literatures have found somewhat weaker evidence of mutual fund selling suppressing prices. We actually find something very similar along the way, but we find, looking at sales by other participants, that we do still see fairly substantive effects on prices of what we call fire sales. So we sort of reconcile literature rather than being intentional with any particular part of it. Okay, so all fire sales papers essentially are looking at the effect of some sort of exogenous variation in sales on prices, or as we've expressed here, returns. Okay, there are enormous problems just with sticking in mindlessly sales on the right hand side and returns on the left, because there's obvious endogeneity problems, primarily arising from the fact that clearly, even in the absence of any sort of fire sales, not fundamental information about the borrowers, about the bond quality, perhaps because of the issuer's credit quality, should be encoded in the price and affect demand as well as any sort of supply. So the desire is to instead find exogenous variation that comes from this sort of distressed, non-fundamental driven sources of selling, and then see what effect that has on prices, because that in the end is what perhaps regulators and theorists are most interested in. Essentially, we're talking about finding a shift in a supply schedule relative to, in some sense, an unshifted demand schedule. Okay, so there's big problems with just using sales. So really, the whole literature is about arguing that they have some sort of decent measure of exogenous selling pressure. Okay, so Cobble Stafford kicked it off. They found mutual funds who had very narrow funding structures, who, when there were any sort of redemptions, would have to dump a bunch of assets, and they showed, or claimed they showed, sort of fire sales effects. This has been refined in certain ways, but notably by Edmonds et al. But I guess the main point I want to get across here is that in recent years there have been a few important criticisms of this approach, essentially noting that, firstly, you should really, really be careful about adjusting for possible fundamentals information about the bonds. And because most fundamental information about bonds comes from essentially the issuer, Choi et al. Point out that you should look within issuer, indeed within issuer time, to see, well, if this bond is more heavily sold than this other bond by the same issue from the same issuer, then that plausibly diffs out any issuer time level fundamentals. And it's a powerful and very advisable approach to take, and we will incorporate this. Secondly, there's a more mechanical attack, which is simply to point out that some of the measures people have been using have just mechanical correlations between the way the selling pressure is constructed and the thing they're trying to explain, which is the behavior of prices. Okay, I don't have time to get into that extremely inside baseball terminology, but essentially it's because they encode, when scaling and renormalizing, they encode the price of the asset today and the price of the asset tomorrow, i.e. therefore the returns, in how they construct the measure. Okay, so if you're saying, well, what's the effect of this measure on bond I, they've already sort of loaded the dice in favor. Our measure actually strips out essentially almost all information about bond I, so we avoid this mechanical effect. Okay. Data, we've talked about it already today, really is this stuff in red that's really key. We have a bunch of very granular bond transaction data. We aggregate a very fine time interval of a week, which is much finer than most studies, in fact. But the point is, we've just got a pile of bond data. Okay, that's essentially it. We can use this to align ourselves and compare with the existing literature I've already discussed, which really focused on funds, and for that you want to know, how those funds are doing, what they're holding. But really, the essence of what I'm going to talk about today certainly is just from the bond transaction data. Okay, right. So the idea behind what we do is to say, well, in some sense, let's say we've identified a bunch of unrelated bonds, and in our final analysis, this is going to be achieved by including enough controls and fixed effects. But let's just assume we found unrelated bonds, okay, and there's nothing else going on in the period. We can deal with that, the systemic events point with some fixed effects along the way. But the point is we're trying to get a sense of whether or not these investors are selling bonds, because overall they're selling other bonds. We're trying to get to the position where we can say, look, this bond is being sold because this investor is perhaps in stress, as such, is selling a bunch of other stuff. Okay, so rather than using sales of the bond that we're actually interested in, i.e. whose returns we're trying to figure out are being affected by this pressure, we're going to really focus on whether or not it's being transacted by investors who happen to be dumping a bunch of other stuff. Okay, and you can see how in a model of files this will pick up the distress of a fund or whatever investor. Okay, which is what we're trying to get at. Okay, now of course there's going to be difficulties in identifying unrelated bonds. Okay, but this is the basic intuition. So essentially, if our measure ultimately, if a bond is being sold for something utterly unconnected, not only to the bond but to the investor, then our measure is going to end up being around zero. If, however, it's being sold by investors typically who are dumping a pile of other stuff, then our measure is going to get big. Essentially, that's the basic intuition. Okay, and that's what's really I'm showing here. So start actually in the middle rather than top. We're going to be adding. We're interested in bond I. We're interested in the returns of bond I and what's driving it. Okay, but we want exogenous stuff, exogenous sales, capturing fire sales to be driving. Okay, so we're going to add up across all other bonds sold by investor J. Okay, to get a measure that is about our bond of interest, relates to the investor J who's selling it in time T, but we're only adding up the bonds other than bond I, so we call it bond K, sold by that investor. And then we add up over all investors. Okay, so we're getting what we call this is a measure of outside. This is just a normalization of the denominator. But essentially for bond I, we're just saying, is it being sold by a bunch of people who are dumping a bunch of other stuff? Okay, the idea is it's going to pick up really a question of the state of the people transacting in that bond. Okay, and if generally they're dumping a bunch of other stuff, this number, the net sales, is going to be big, added up over all people who are transacting. Okay,
this is your 2 minutes warning. This is your 2 minutes warning.
2 minutes warning. Yeah, cool. Thank you. Okay, so that's what we do, and we call it outside selling pressure. If there's a lot of pressure on bond I, it's going to be close to 1. If there's actually, you could have the people who are transacting in the bond are actually buying a bunch of other bonds, then you get to -1. Okay, close to 0 if there's no tendency really among the traders transacting in this bond to be net sellers or net buyers. Okay, okay. So that's where we are, and now we're going to instrument our sales in a two-stage least square sort of setup with that selling pressure measure. Okay, now of course it's quite plausible that selling pressure measure is going to satisfy one aspect of being a good instrument, that it's correlated with sales. But you're probably already thinking, well, maybe a lot of these guys are holding, I don't know, Dell bonds and Acer bonds or Lenovo bonds. And yes, you're saying, okay, I'm looking only at the unrelated bonds that aren't Dell bonds. But clearly there's some shared fundamentals. I hear bad news about chips or whatever, and maybe I'm dumping a bunch of Lenovo bonds, and that's going to be picked up, and that's capturing fundamentals, which is absolutely something we don't want when you want exogenous selling pressure. Okay, so therefore what we include in these controls, our measure of unrelatedness is going to be synthetic again. We include firstly a bond fixed effect that deals with a bunch of stuff like is it secured, etc., etc. Time to maturity, so that's a within issuer time variation across different bonds. Fine, but the key thing is, as in Choi, we include issuer time fixed effects. Okay, so that absorbs anything, any time varying fundamentals about Dell. Okay, essentially we're looking within Dell. We're saying, okay, this bond from Dell is being heavily sold, and is being sold by firms who are heavily selling a bunch of other stuff relative to this other Dell bond. So we're differing out pretty much any story you could come up with. Okay, now that's basically what it said. there's a subtlety which I think maybe Salim will pick up on. So what we're very confident we found here is non-fundamental selling pressure. The reason we feel that it's not only non-fundamental selling pressure, but fire sale selling pressure is, well, intuitively, fire sales are about correlating, and our measure, if it doesn't correlate, it's going to stay close to zero. We also find it relates to some other plausible measures, especially it kicks up during March 2020. So I'm just going to zip through the results because really I want to establish what we were doing, and the results are very intuitive. Okay, instrumenting works, we find a significant effect on the price of exogenous bond selling, i.e. we do find this evidence of fire selling. Okay, in particular, it's much greater during times of stress, and our stress is during the dash for cash. I'm very interested in the results people have shown today already. I'd be really interested to know how much of this is because hedge funds are hoarding cash. Okay, this is actually week by week measure of our negative estimated, on average, but particularly negative estimated effect on prices during the dash for cash period. Okay, it also is particularly great among corporate bonds that you might imagine a bit more complex, less liquid, somewhat more prone than sovereigns to fire sales. And in fact, there's an interaction between the period of stress and the nature of the bond. The extra illiquidity or the fire saleness of the corporate bonds is exaggerated during the dash for cash. And the final point I would make, although this is preliminary, I said to you that in the literature, careful people have shown that maybe evidence of mutual funds is a bit weaker than it's been initially cracked up to be. Well, we actually find something, in fact, we get to find a sort of weirdly slight artifact positive effect. But the point is we get a negative effect from a lot of participants other than mutual funds. So we're actually sort of reconciling the literature, but with a more solid exogenous variation measure. So thanks for that.
Thanks very much, Rhys. Rushing through to Salim. Salim, over to you. And I don't know whether there is a way of sort of squeezing the...
Yeah, I'll try and be as fast as possible. Hello, everyone. So thanks so much for the invitation to discuss the paper. I'll try and be quick, given how much time is left. So yeah, I enjoyed reading the paper. I mean, I think it's my sort of fundamental take about it was it's about measuring price and impact in dealer-intermediated financial markets, of which fire sales is, I think, the most important example of that. I wanted to just sort of put the paper in context a little bit from a theoretical perspective. That's what Rhys didn't do. He sort of went through the empirical literature, and hopefully this will help the authors think about what they're doing, and I'll pick up some issues regarding the empirics, and hopefully I'll manage to do it all in 5 minutes. So I had in mind a simple car model when I was reading the paper, and the car model is a model of sort of adverse selection in financial markets. So the dealer is trying to price an asset, there's some fundamental asset, the value doesn't know it, and has a prior mu. There's two traders. One is our non-fundamental trader, that could be the fire seller, or, who submits some random order U, and an informed trader, fundamental trader who knows V and submits an order X, which is proportional to how much the dealer's prior, which could be the prior price, deviates from the fundamental, and this beta will be endogenous equilibrium. And the dealer actually sees the orders, Q, okay, that's what sort of Rhys is having in his regression model. But Q is a mix of informed and uninformed trading. And so when it prices the asset, it uses its prior plus the information context of its orders. And then we have the prior plus potentially order flow or sales. So this is the regression that Rhys runs in his paper. So we have a theoretical grounding for it. And imagine you want to get at this lambda term, okay? If you actually knew mu, you could just literally run a regression of P on mu and sales, but we don't know mu precisely. And one reason is, as we said, we have public signals that can shift priors around and be correlated with trading. There could also be other things like transaction costs and stuff. So we can have a proxy, mu tilde. Mu tilde would be a mismeasured version of mu, and the issue is that measurement error, E in my notation, is correlated with fundamental selling, okay? But hopefully not the stochastic selling that comes from our noise traders or our fire sellers or our non-fundamental traders, okay? And so the thing is, Rhys wants to get at this lambda. He needs to find some way of dealing with the simplification problem, and they do two things. The first is, let's basically just try and get as close to mu as we can and concentrate the model with a bunch of fixed effects, okay? So loads of covariates and control for all issuer level information we have by using issuer level fixed effects, okay? And then he proposes an instrument of this, which is an IV, essentially, which is supposed to be correlated with U by T. And that's, imagine we have some other assets, okay, done it in imitation here, just imagine a different asset J. The covariance between the noise trading or the non-fundamental trading for asset I and asset J is non-zero, but the covariance in the fundamental trading between these two assets conditional on the proxy for the prior that we have is zero, okay? And then QJT becomes a valid instrument, and we can use sales of other assets to identify lambda. And then, you know, Reese explained it very well. We can aggregate across different agents to try and get at a better instrument, perhaps. Okay, so that's basically the paper in a nutshell. I've written it in terms of price impact, but you know, and I've used the term noise traders as well occasionally. You can think about it in terms of fire sales as well. I'll come on to that in the next slide. Okay, so there's something slightly odd about this when I was reading the paper. So the first solution we have relies on there essentially being a very similar control bond. You need del bond A and del bond B in Mises language. But the second solution requires there being very different bonds. And so you have this sort of disconnect between two identification strategies. You have a requirement for a similar bond to get the fixed effect and a different bond for the instrument. And it really was not clear to me which one was driving identification, because that'd be useful to know. And I think, you know, just showing me the value out of the IV versus the fixed effect would be very, very helpful to understand that. And also it will sort of put the contribution into context. The contribution of the paper is really this IV as opposed to the fixed effects, which has been done elsewhere. Okay, and I was a little bit concerned about the fixed effect. I mean, I used to say to in the past myself. I mean, like I worry that essentially, you know, these are very illiquid bonds, and they are traded at different times by different dealers. And even though you may have sort of common issuers, I worry that basically the price of one bond may be discovered at a different pace, for instance, or the trading may not fully happen. And even though you observe a different bond by the same issuer, you really aren't getting the full information that's available from this price. Okay, so that was something that sort of concerned me. And actually, look at the fixed effects; they only explained a very small variation in the quantity traded. And this sort of linked to this is, should we actually think about this lambda IT as being different for different types of sales as a result? So you have XIT and UT. This is the fundamental versus non-fundamental trading. I mean, Reese is really going after the coefficient on UIT. In my simple model, it actually doesn't matter which one you go for. So was it the case we're thinking about this measuring price impact in general, or are we thinking about purely non-fundamental trading? I guess it's more the latter, but does that make a difference? And if it does make a difference, these actually treat different customers differently. So you show this result that asset managers react very differently, or sales of asset managers explain returns very differently. Can we do more than that? How about hedge funds? How about different types of customers? Okay, and I totally agree that the corporate bond, the government bond versus corporate bond results make perfect sense in that regard. Okay, I'll remark very briefly on fire sales versus.
I mean, this is your 1 minute warning.
Okay, fine, thank you. I think I agree with Reese that fire sales are a good example of a time when, you know, non-fundamental trading between two different types of assets will be correlated. And, you know, there is, as I said, a more general interpretation in terms of noise versus fire sales. One concern I had about stress is that in a model which is more general than one I put together, where you actually do have some transaction costs or some constraints on dealers, all those things are nested in the mu. Okay, the sort of essentially the supply curve from the dealer, and it is likely that mu is correlated with selling pressures. You know, in a stress, both dealers get constrained and the mutual funds will get constrained too. And that does mean there's a covariance term which is kind of ignored. And I was worried that that's actually violating the exclusion restriction. I would like to see more sort of dividing up stresses versus non-stresses. So is the first stage stronger? Because that's what you'd expect to see if this was true. Are there asymmetries? So are sales more important than purchases? is there actually any power outside of stresses? We only show the sort of stress versus sample. What's the outer stress period look like? Okay. And the final point I wanted to make, if I'm probably into minus 30 seconds by now, is just that, there's no acknowledgement at all that these are bonds that have a particular duration attached to them. They will be priced off some sort of SDF, presumably, and you would imagine a situation where there is news about the SDF too. Okay, so if you have two long-dated bonds, presumably selling of one may be related not so much to news about the cash flow of the issuer, which I can call YS in this notation here, but more news about long-term discount rates. And if you're controlled for your issuer characteristics using a short-term bond as your sort of control bond, as it were, then that's not going to help you. So that's one thing just to bear in mind. And you could do more to deal with this, and duration time fixed effects would be one way to deal with that. Okay, so I'll stop there and probably over time. Thank you very much. It was a very interesting paper.
Thanks, Liam. Appreciate it.
Thank you very much, both. I clearly chaired this very badly, and we are in extra time. But I'm keen to actually give the speakers a 1 minute chance to say something about the comments they received. And if we can start with Giovanni, 1 minute, and please stick to the 1 minute, followed by Anne-Caroline, Guillaume, and then Rhys. Thank you.
Thanks a lot, Alina. No, thanks a lot, Marco, for the comments on the paper. Definitely, you read very carefully the paper, and there is not much to reply. I need to address them, especially on certain parts of the analysis and the statistical analysis of the network structure of the UK banking global network. And they are valid points, so well taken. No, not much to add on my side.
Brilliant. Anne-Caroline?
Thanks very much as well, Karamphir, for your interesting comments. I fully agree that we need to dig deeper in terms of trying to explain how the different moves in market structure of the hedge funds are coming about, why it might be that different trading strategies matter, and why they might move from net sellers to net borrowers, etc. Maybe just to say that this is still very much early stages of the paper, so I think this will definitely be very well taken to shape kind of the deeper analysis and also the deeper statistical analysis. So thanks very much.
Thank you, Anne-Caroline. And Guillaume?
Yeah, thanks. Well, thanks a lot, Arthur, for the discussion. So, no, yeah, same as Giovanni, very well taken points. Most of the things you listed are things we wanted to explore. So looking at nonlinear, the dynamics of rebuilding the LCR, the interaction also with key data, especially like the distance to disclosure, something that we want to do more. And yeah, also your initial point on real reluctance versus prudent actions in stress. This is like a really key question that we need to think a bit more carefully about, because that's really key to the whole question. So thanks a lot, Arthur, again.
Thanks, Guillaume. And finally, Rhys.
Celine, thanks for the careful reading. There's lots to work through. I appreciate it. The Kyle thing, we were talking about Kyle and have something very similar to your sort of slowly building up the covariances in place. It's not quite ready yet, but looking forward to chatting at the bank and maybe take you through at some point. Appreciate it. Good to see you as well.
Thank you very much, all. And can I say a big thank you to Giovanni as well, who orchestrated this, the entire session. Thank you very much, presenters and discussants too.
Cheers, guys.
Good to see you all. Bye-bye.